Good afternoon. Good afternoon. Thank you so much for joining us here this afternoon. Fantastic to see a full room, hopefully everyone fed, watered and energized after the break. Really excited to just make a few introductory comments to this session. I'm Fiona Watson. I'm a Senior Director in the Redefining Value team at the World Business Council of Sustainable Development, joined today by Luke Blauer, Senior Manager based in London, who's going to be moderating and leading on what I'm sure is going to be a really interesting discussion. Just before we do, we wanted to put today's panel and the discussion and hopefully your mindset in the context of the work and approach of WBCSD to this topic. So some of you may know us, but in case you don't, we are a CEO-led, so purpose-driven CEO-led organization, membership of over 250 of the world's largest companies who are all sustainability leaders or working towards that. And we all have the desire to raise the ambition for a better world. The way we approach that is where we lead with that clear vision. We seek to transform through ideation and collaboration, guidance, bringing together members and other members of the ecosystem into discussions like this today, and ultimately to amplify the voice of leading businesses towards what we see as success. Success being where leaders, business leaders and corporations and participants across the world feel empowered to raise the bar for increased sustainability performance. Luke and I are in the Redefining Value team, which is one of the three main areas of WBCSD. Not surprisingly, our areas of focus are on performance and today's topic, valuation. So with that, very pleased to hand over to Luke, who's going to lead the discussion and announce a really interesting publication that he is responsible for today and for which I personally and WBCSD applaud his efforts. So thank you all for joining us and thank you for being a part of the discussion.
Brilliant. Thanks so much, Fiona, and thank you all so much for being with us this afternoon. We're really hoping it's going to be a good discussion. We've got a fantastic panel who I'll introduce soon, but just to give a little bit of context on WBCSD's work on this theme on valuation, we have released this primer here today. So get your cameras out, go to the QR code, please do take a look, critique it, give us feedback. We'd love to hear from you. But we want to look at this link between sustainability, risk opportunity, sustainability factors and valuation. And we want to look at how investors are integrating into their mainstream processes, fundamental valuation, intrinsic valuation, etc. And WBCSD largely corporate membership, but we want that kind of feedback loop. We want that kind of check-in from capital markets of how's all the information that corporates are now providing being incorporated into the kind of core investment process. And we're going to hear from Richard and Jean-Philippe on exactly that theme now. So I'll just fly through a little bit of this primer. What have we done? So this is not rocket science, we're just kind of mapping the existing landscape. But we've looked at the relationship between sustainability and then valuation. We've broken it down into these different steps and different entry points. So of course, the context for a business, the risks and opportunities, their exposure through transition, etc., is absolutely fundamental. And then the response of the business in light of that context. And that flows through to this kind of strategic environment, the competitive forces, think about PESTLE and SWOT and all those sort of things for a business. And that then flows through to the impact on supply, demand, price, thinking about the organizational health of a company, which ultimately connects to the financials, forecasted financials. What are the implications on revenue, cost, investment, asset value, and also some of the kind of trickier bits that sit in model assumptions. What do we do with terminal value? What do we do with kind of risk premium? Different ways of looking at it. But ultimately, we want to break down how sustainability can show up in this valuation process. And that's what we've done in this primer that is looking at, what's happening today in existing investment processes. So just to take one example of that kind of entry point, and I think a pretty key one, we term it kind of accountable elements, but this is basically making the financial link, the financial statement, financial accounting link. So climate-related transition risks, how's that going to affect useful life of assets, in potential impairment, physical effects, what's that going to do to asset value or costs, changing margins, changing investment profiles. We're thinking about this connection between sustainability and the financials fundamentally. And then, as I said, there's these kind of trickier bits that sit in model assumptions, and we're talking about growth rates, we're talking about terminal value, we're talking about cost of equity debt, WACC calculation. This is a trickier area, but we are seeing some investors beginning to kind of play around with these topics to try and capture some of this risk opportunity and the implications for companies. And I just wanted to, and there's too much text on this slide, apologies, but I wanted to give a couple of shout outs and examples to investors who are publishing research, and we'll hear from others on the stage shortly. But just to ground this, so our framework, you see that on the left-hand side, those colored boxes. We've then applied that to pieces of fundamental research. And this is an interesting one with Aberdeen kind of looking at the climate impacts on costs, abatement, demand destruction, creation for different sectors. This is another one looking at deforestation and then what that might mean for demand and costs for meat packing companies, JBS, Marfrig, etc. And this is another one, pretty obvious one, of course, on that decarbonization trajectory and the implications for oil and gas supply and what that might mean for growth rates or the implications on the revenue, etc., for oil and gas companies. So we're seeing examples of this kind of integration, sustainability into valuation. But we know that there's a lot of challenges that still need to be explored. You've probably noted quite a few of the examples that I just went through there are looking at the kind of climate side, but then what are the differences between different ESG factors being incorporated? How do we capture some more of that kind of qualitative characteristics? Looking at how well companies are positioned through transition. What do we do about all the uncertainty that we know sits in the pathways and the potential of particular solutions? How do we get back to looking at how and where externalities can be internalized? Obviously, sometimes that comes through taxes, sometimes it comes through particular policy measures, and there's a long list. So what we've done in this primer is just explain the kind of lay of the land, try to give some examples of that integration in research, but we're acknowledging there's a lot of challenges outstanding, and perhaps we'll dig into some of that on the panel. And then I think this is the last slide for me. So headline is, we think this integration is happening, valuation integration is happening, but I think we need a lot more effort from companies, in terms of effective communication, from investors in terms of investing in the research capabilities and fundamental integration. Research providers, think about their role. There's a lot that needs to be done in that kind of ecosystem to advance and scale the practice, but it's happening, and there's more to come. So with that, I'm delighted to turn to our panel, and I'll just quickly introduce them in turn. So we have Andreas, who's Investor Relations at Mercedes. Thank you, Andreas, for joining. Leila, who's Head of Sustainable Finance and a part of the Capital Markets team at Holcim. Jean-Philippe, who is Head of Responsible Investment at Edmond de Rothschild. And we have Richard Manley, who's Chief Sustainability Officer and Head of Sustainable Investing at CPP Investments. Thank you all so much for being with us today. So the thinking with this panel, of course, is to get this mix of real economy, financial economy, think about this interplay between companies and the recipients of information, users of information. What are the kind of needs? What are we seeing in terms of that integration, both on the equity, but also, Leila here, on the fixed income and debt side too. So I think I want to come to Andreas first. It'd be great to hear, Andreas, what you're seeing from equity analysts. How are they looking at sustainable mobility in the future and Mercedes' role within that?
Hello, hello. Oh, here we are. Okay, thanks, Luke, for the question, and hello to everybody in the room. Maybe just to frame it as some introductory remarks, so I can share obviously my insights here from the machine room of investor relations working on ESG in an automotive company. That looks probably different than what Leila, for example, is doing, but just to give you some numbers, so we are in regular contact with 25 to 30 financial analysts, so auto sector analysts, which have deep knowledge of the automotive sector, and on top ESG analysts from the sell and buy side. And we still see a very well distinction between the two parties, so financial, automotive sector analysts and ESG analysts, even though we would have thought that is merging at some point in time. But actually, and if you look at the automotive sector, it's obvious that we have to address all three letters of ESG, and that's what we have done at Mercedes with our sustainable business strategy back in 2019, and the Ambition 2039, which is about net carbon neutral new vehicle fleet at the latest by then, and always addressing here the entire value chain, so from mining of the materials to recycling and along the product life cycle. And that's making it also complicated in terms of integrating these different aspects into valuation of companies, I think, and particularly what we can see in research from financial analysts. It's very clear if you talk about decarbonization, which life cycle phase is of most interest. It's about tailpipe emissions. Why? Because that is regulated by law. We have fleet regulations in the different regions, so you can quantify that. You know where the company needs to, that it has to achieve a certain target in terms of fleet emissions, and if not, you can quantify the fines that have to be paid. So that's easy to integrate, to some extent at least, easy to integrate into valuation of companies. If we go then further down, and that's also the common interest of both, so ESG analysts and financial analysts, definitely. And then if we go further down the supply chain or the value chain down to the supply chain, it's getting more tricky, because here we're talking in terms of decarbonization about new technologies like green steel, green aluminium, which is not at scale yet. So we have to make investments, or when suppliers have to make investments, which are not directly under the control of an automotive manufacturer, but where we as a company can pull to some extent these new technologies, support them, also do equity stakes in green steel manufacturer, for example. But that's the question of, okay, what will that be in terms of impact on costs of new vehicles when we make the transition to electric vehicle, where we say to become net carbon neutral. And that's addressing then all the stages. So we need to consider cost increases probably from green materials. That kind of questions is also part of financial market analysts or analyzers, but also very much in the focus of ESG analysts. Same applies to the question of battery, raw material, and how we secure supply chains, taking into the consideration what we have seen with semiconductors in the last couple of years. So there are common interests, but if we move further to the social parts and then even the governance part of ESG, it's getting more fuzzy, especially when we think of, okay, how can a financial market analyst with a very deep knowledge of the automotive sector integrate social aspects in a financial valuation of the company, on what he or she is then based their target price on. So, and giving a recommendation to investors. Even though that's just one piece of the puzzle that investors have to take into or can take into consideration, it's especially from a short-term perspective a very important one for a company. As you know, we all do quarterly disclosures where most of the time still financials, profitability is in the interest of those analysts taking part mainly. So social aspects, much more difficult to quantify. I think Jean-Philippe can tell us then about intangibles and how they are integrating it, but it's even more an issue to integrate it into financial analysis. For ESG analysts, it's definitely one of the most important parts next to climate change and our decarbonization efforts. When we look at just transition for the workforce, when we look at supply chains and human rights, and then the governance part finally, and that's what I close with. That's actually mostly related to the interest of stewardship teams in the context of annual general meetings, where we then intensively engage with these parties to discuss specific governance topics, and which is very rarely integrated into financial analysis. I mean, it's in any case, it's just in the interest if there's a top management trade, for example, right, which could have a very significant impact on the company's performance. But other than this, it's mostly related around, or mostly centered around annual general meetings, stewardship teams, and ESG analysts.
Brilliant, thank you, Andreas. So that's an initial reflection, obviously, from the corporate side, investor relations, on the kind of equity activity, and obviously a sector that's seriously accelerating on the transition, no pun intended. I'm going to come to Leila next to kind of pivot to more to the fixed income and debt side. Be great to hear from you, Leila. What are you seeing in terms of fixed income markets, and why did you put sustainability at the heart of your funding strategy? Do you see any differentiation in pricing, etc.?
Thank you, Luc, for the question. Good afternoon, everyone. And I'm very glad to be here today and to be able to respond to your questions, Luc. On the fixed income side, ESG is also indeed a very important topic. So there is a major interest and engagement, from the investor side. We do have regular calls with our investors, and we discuss about, our decarbonization strategy, our roadmap, our actions. However, investors, they don't only rely on the ESG rating. So they really like engaging with the issuers, and to talk about the strategy, and that's something that's been very important at Holcim. Investors, they don't only rely, on your public disclosure, so they want to engage with you in order to make their own assessment. They have their in-house analysts, and who make their own analysis of the company, and that's the first part that I wanted to mention. What we also see at Holcim, that we really value the engagement that we have with our investors, because they have the power to drive strategic changes for the company, and ultimately the sustainability agenda of companies. What we also see on the market, when there is a new bond transaction coming, issuers also highlight their ESG rating to make sure that ESG is not an issue also from an investor bond perspective, and this has no impact on the valuation of the bond, and the right valuation is captured also thanks to the good ESG profile of investors. And another point that I want to mention, it's about the credit rating agencies. Also, they have integrated the ESG profile of issuer. They make their own assessment. It used to be a qualitative assessment, and now it became a quantitative assessment, which means that ESG has a value. So if you don't, put in place the right thing, and you don't have a strong ESG profile, this will be reflected in a way in your also credit rating, because ESG is a financial risk, and this has to be, of course, valued in any credit profile assessment. To respond to your question, on Holcim and how we have integrated sustainability within our funding strategy. So basically, at Holcim, climate is a central question and is at the core of our overall strategy. We have started, our journey a couple of years ago already, and this has started by setting very ambitious targets to tackle our scope 1, 2, and 3. And also, I believe that finance has a key role to play, in addressing today's climate crisis. And in finance, it starts, of course, by also making sure that you are doing the right investment, that you are investing in green capex, and you have the right funding strategy, in order to fund your transition. And what we've been doing, it's in 2020, so we have issued our first sustainability-linked bond linked on our climate target. And why we have done it, it's really to show to our investors that we are committed by all means, to reach our target. And it was for us also a way to link our funding strategy with our sustainability objectives. We also do have target for sustainable financing, so we want to reach 40% of sustainable financing by 2025. And within the same time frame, we want to invest at least 500 million in green capex. And we have also a policy to invest in carbon capture technology, because we know that for cement industry, it's a very important technology, in order to reach net zero. And we want to invest 2 billion in this technology by 2030. So that's what we did on the investment side. I mentioned that our funding strategy is also aligned with sustainability. And what I would like also to add is, more you transform your business, and more you will have also opportunities, to have green financing. So aligning finance and sustainability, I really see it as a virtuous cycle. Because more you invest, into the transition, more you show to your investors that you do have this capex, and your investors are also happy because you give them also opportunities to invest their money in a more responsible way. Last point was on valuation. On this one, when we issued our first sustainability-linked bond, we really saw a difference in the pricing. We had a fantastic pricing, negative new issue premium. But in today's market, this is completely gone. You don't see it anymore. But there is still a small differentiation that you see on the green bond market. And what we did also at Holcim, we have recently updated our framework in order to be able to issue green bonds. And we have aligned, this green bond with the European taxonomy. So that was also, a journey, to have a framework aligned with the European taxonomy. But we also discussed with our investors, and we felt that was also important, and also to have, a framework which is based on best practices. Thank you.
Brilliant, thank you, Leila. So great to kind of have the fixed income perspective to complement the equity perspective, and there's our corporate position, collective. And I'll come to Richard next. Be great to hear from you, Richard, on where you think we're at in terms of this integration in fundamental analysis, whether we're seeing this move on pricing. I note, of course, Richard, you're a member of the TCFD, and actually, I think maybe last year's status report, they had this kind of dedicated section on looking at the kind of pricing of climate risk. And yeah, so if you could look at that kind of, maybe the climate example would be great.
It would be so easy to say we've nailed it. We can price it to the basis point, fully integrated into everything we do, but it'd also be really dangerous. So 20 years ago this year, I was minding my own business as an oil and gas analyst until Secretary General Kofi Annan asked, could good companies do better? And at that moment in time, we looked at all the oil majors, all the CSR reports they put out, and built what was probably one of the first sell-side, so equity research, materiality matrices. And we could see the oil and gas industry was changing. It's an industry that used to compete around the provision of an engineering solution and cheap capital. But it was very clear that those companies that were proactively engaging to partner with the nations, drive down health and safety issues, drive down corruption and bribery, create local content, deal with unnecessary flaring, deal with environmental remediation, were actually winning more of the world's hydrocarbon opportunity. Roll forward 20 years, and I still don't have, for a single industry, globally, a single metric reported on the same basis and independently verified for the same period. Okay? Now, when we typically talk about regressions and price discovery in capital markets, we're talking about regressing hundreds of data points. Okay? I don't have a single data point for a single period yet. Okay? We'll get there. We'll get there. But just because I don't have it doesn't mean we shouldn't actually try and quantify the value of it. Because I don't think there's a debate to be had. And you just heard two issuers indicate, I didn't hear a single normative argument for why they're doing this. They're doing this because there's a genuine belief it will enhance the value of their enterprise. And I could put arguments out there that clearly companies that kill their employees are going to have business interruptions that detract from margins. Companies that have high voluntary attrition are going to lose margin. Companies who fall foul of a cyber attack, look, best case, 2% fine for failing on GDPR, potentially shut the business down permanently. So I don't think there's a debate here to be had about the value of doing it. What is challenging is doing it systematically at scale. And that, therefore, I think lends us to, look, that there are examples we can start to see it happening. Green buildings. Green buildings trade at a premium. Why? Because the service sector has realized the only way I can deal with the 20% of my emissions that are occupancy is move my headquarters. So green buildings have 100% occupancy rates. They command a premium. They get advantage financing in the credit market because green bonds are issued against them, and they get an advantage cap rate, so they command a 20% premium. But that's a single asset class where, importantly, and we can take it here to the theme of this session, it's translated straight into price discovery. And the most amazing thing happens when it translates into price discovery and you can quantify it. Very quickly, the whole industry, the actual operating industry, but also market participants financing the industry, move very, very quickly to do it. So I'd love to be sat here saying this is a precise science. People are going to be writing, theses and getting Nobel Prizes for this sometime soon. The good news is the ISSB has landed. Hopefully we can see regulators around the world adopt that in the next couple of years. We can move towards a global baseline, and then we can build upon that global baseline and start to have the data set that will allow us to do the kind of regression analysis we want to do systematically. But it's very clear this drives value. Now, we haven't really had time to talk about CPP. 55% of our program is private. We're appointing directors, we're approving business plans. We get a lot of disclosure in that part of the portfolio that we wouldn't ordinarily get. And there we are able to, as we're underwriting and building value creation plans, be quite actively involved in identifying areas for value creation through enhancing sustainability. And there we can try and do it systematically and objectively and quantify it. So a good example, in developing a transition plan, identifying efficiency measures that not only reduce carbon emissions, but they drive down operating costs. You can quantify that, you can tax it, you can put it on a PE multiple, you can do it pre-tax, put it on an EBITDA multiple. You can ascribe value to those things. Now, you can actually also ascribe value to reducing voluntary attrition, but it's harder to do because you don't have uniformly disclosed voluntary attrition data for the whole industry. But from an inside-in perspective, if you're head of HR, you can clearly look at what are the costs associated with losing people, having to hire people, having to reintegrate them, the burden placed on other colleagues as a result of the fact that you've lost 10% of your workforce. It may in the near term have to be approximation, but I don't doubt that as we move forward and more companies start to use this data, and this is an important element, use this data, they'll derive value from it. So why do I say use this data? I had a rather alarming conversation not too long ago with a company where I asked them the question, what are you going to do about fatalities? And they said, well, we're doing a great job. We've massively reduced fatalities. I said, but surely you normalize this data and look at yourself versus your peers. They said, well, what do you mean? I said, if I were to work for your organization, I'd be working for the most likely place to die in your industry globally. Should you not be seeking to make progress on that? And the board didn't know. So look, there's value in this data. There's value in the performance, but there's no value in reporting it. Reporting is a compliance exercise. This data, I think the value comes to life when you start to actually use it. So talking maybe to climate, one of the challenges we confront, ambition is a great thing. We've had 3,000 companies now commit to net zero. We're not going to get there without the ambition to do it, but that's forward-looking guidance to the market. That is actually 27-year forward-looking statement that I will comprehensively decarbonize my business. These are companies that don't normally give more than 2 years earnings guidance. I might need a little bit of help in just corroborating, is that ambition or is that a slam dunk? And what we've started to do in the portfolio is, and we've done this now on 12 companies, we've done it to ourselves, it's not an easy process. You don't always like the results, but is start to leverage oil and gas reporting. You're probably aware the oil and gas industry in the US has to report proven reserves and probable reserves. Proven are those that are technically and economically almost certain to be recoverable. probable, technically feasible, not quite economic, is actually start to say, hey, what is our abatement capacity? If we're going to remove 100% of the emissions from the business, what percentage of the 100 is technically and economically feasible today? We'll call that proven. What's technically feasible, but not quite economic, and we can have specific assumptions about the break-even price we care about, we call that probable. And then if it's technically not possible and not economic at $150, let's have a conversation about that being uneconomic and debate whether we should stop that activity, offset that activity, or actually diligence prospective breakthrough moonshot technologies that make it probably and ultimately proven economic over time. And that is the case, I think, where there's real value in doing that. Because if I have two companies where one says, I'm 20% proven, 25% probable, 55% a hope and a prayer, and a peer is 55% proven, 40% probable, 5% residual risk of not being able to decarbonize, there is very real value in that will clearly translate into equity prices and into fixed income prices. One maybe last point, building upon Leila's comments. We are a pension fund. The fund is levered. We're actually the first pension fund to issue green bonds back in 2018. We're the first green bond strip for a pension fund. The most interesting thing is that there's definitely a value in issuing green bonds over normal bonds. But the one thing that we've noticed is the breadth of the investor base buying green bonds is far larger than those buying our conventional bonds. And the oversubscription rates for everything we issue are far higher than a normal bond, and the pricing is more favorable. So I'd say where issuers are in ability to issue green securities, there are multiple benefits in terms of understanding the investor base and the breadth and depth of the market.
Brilliant, thanks, Richard, and really important point on that. Focus on the use of this information, use within companies and use within markets, and good that you make the ISSB call out. We as WBCSD are going to be supporting uptake of ISSB, preparer forums, getting the real economy together. And I think you do get this kind of value valuation link because you've got to talk about the impact of sustainability, risk and opportunity on financial performance, on financial position, and you've got to connect to financial planning. So yeah, I think that flow through is really important. Start thinking about questions for the panel audience. You've all got microphones in front of you, so we want to make use of those. Please just start thinking about questions. We'll come to you shortly. But first, Jean-Philippe, it'd be great to hear a bit about how you've approached different evaluation techniques and methods, and perhaps what you're doing a bit more, perhaps on the social side, organizational side, intangibles.
Thank you, Luc. Good afternoon, everyone. The first thing I would like to say is to congratulate WBCSD because they choose a tough and courageous subject, and we need brave people, so thank you. Why this question is so important as investors? Because we only have one brain, with or without artificial intelligence. Well, that's one point. So we need simple tools to concentrate the way we're going to invest. So capacity, at the same time to address sustainability and the way we do invest. So that's simple things. So Luc reminded me that a couple of years ago I was in the sell-side industry, and we published some research with the concept of WACC. So WACC with the approach of remunerating all capitals. So I think it's public report, so you can have it. But so now I'm in the field of asset management, and we adapted the way we can, in the long term, address DCF, which is the most common, valuation method. Because of long term, because I've been in the sell-side industry, and you can trust me, the horizon of time when you do a financial recommendation is 12 months, 18 months, maximum 24 months. When we think about sustainability, it's 2 years, 5 years, a generation. So really we need tools really to go beyond the short term, which is clearly one big challenge. The second one is intangibles. I mean intangibles, when you invest today, the future value of your investment, the majority rely on intangibles. I mean human capital, the people, relational capital, the brand, okay, the brand, the clients, your supply chain, your reputation, and last but not least, your organizational structure, data. Everyone says data today. But also intellectual property, your IT. So that's what you invest. And accounting, you have nothing in the financial statements. So you need also to innovate, because 50 years ago, that was not the case. I mean, but today and tomorrow, because of data, etc., that's the jobs we have to do. So what we do, it's very simple. We develop some tools, starting from the scores we get on analyzing, in terms of sustainability, some corporates. And at the end of the day, I mean, depending on the score, with risk and opportunities, and depending also on the intensity, ESG intensity of the sector. So I can tell you that for Mercedes and Holcim, they are in our sector high intensity. That will not surprise you. I mean, we have a tool that we share with all our portfolio managers, having in mind that experience, because I'm also a portfolio manager. I'm part of a team managing a European equity fund with the climate objective and the social one with a global horizon. And what we do propose, I mean, in addition to the traditional financial valuation, it's not to say that we put away finance, economic, strategy, but we bring an additional message in the long term. If you are ready to go beyond 2 years or 1 year, I hope you are. I mean, we put an impact on the target price for equity. So it can be up to 10% and minus 20%. And we work a lot with some academics to design that. So it's not I mean, quantitative. It's just experience that we got as practitioners and also with academics. So for instance, we worked with academics, and they did an interesting game. They put some financial analysts. Part number 1, I give you only financial figures. Part number 2, I give you positive ESG metrics and data. And part number 3, negative. And I see the way your impact on our financial valuation. So that's the kind of things we've done. And we note, like a lot of practitioners, that investors in practice, they integrate more to third-party risk, but also solutions and opportunity. So that's kind of the things we embark. So that's for equity, impact on target price. And for fixed income, it's in terms of noche, because when we discuss with our portfolio manager, it's too complex to go with the spread. So we discuss, we prefer to have simple tools that they experience, and they can use it with the concept of half noche and decide to use it or not use it, to invest, to disinvest, to increase their exposure or to reduce it. And then we have some SRI mandates where they have to apply it automatically, if I may say. But so that's, like, I would say, innovation and experience. But we are happy with that.
Thank you so much, Jean-Philippe. So I teed it up. Very welcome to ask a question to the panel. Does anyone want to kick us off? On the event description, this was titled an interactive discussion. So please do contribute and share if you'd like to. Yeah, go ahead.
There could be many questions here, but to those of you working on the investment side, this is the most tricky part of it, right? And what you reckon, if you look at say the European asset management industry, how many years do we need to actually educate portfolio managers and analysts to actually be able to do this?
Yeah, tough question. I think that the challenge we have here is this is complex, and as a species, when we confront complexity, we seek to simplify. And the challenge of oversimplifying this is, at least from our experience, is there is not fact in ESG metrics and scores. There are breadcrumbs to drive engagement. And ultimately, I'd say today, my appraisal of something, that a company that has governance that's consistent with best market conventions, has proactively identified all of the material business risks at the nexus of their operations, has in place the policies you would expect to help mitigate that risk. Performance on the metrics consistent with having translated those policies into changes in behavior that were de-risking the enterprise and allowing them to capture opportunities. The best you could probably say is this board appears to be overseeing the executive to put in place the institutional controls and drive a change in performance that, if it is ultimately an evolution to a more enlightened corporate culture, is likely to extend the duration of any industrial and financial moat around the business. But the notion that that therefore becomes a AAA rated security that I can buy with my eyes closed and not worry about is probably not the appropriate conclusion. And it's that nuance here that is one of the reasons, I think we've heard the question of the observation earlier on, that a lot of institutions are still separating fundamental research from ESG research. An example, one of the oil companies, you could always say they were really progressive on their ESG performance and doing really well on some things, but they have a habit of what we used to reference as killing and spilling. And their performance on all the other stuff was getting them really high ESG ratings. It was the performance on killing and spilling that was undermining the value of the enterprise. And that's another thing issue is which is the key issue that potentially erodes or drives value in the enterprise is not always the average. So I think it's going to take time because we're trying to here quantify and appraise culture. We're always going to want to regress to some simple metric to pin that to. And that's not obviously the right approach to take here.
To complete what Richard said, the first thing is if you really want to do ESG integration, you need to put the people around the table. And at the end, they speak the same language. So my boss is a chief investment officer, and all around me, there is my team, and all the portfolio manager, equity, fixed income, convertibles, asset allocation. And every day, we are together. So that's a very simple, important thing. There is a question of data, of course, but then you need the experience to analyze the data. Because, for instance, for governance or social issues, you need a lot of experience. Just give you an example, my team, we are 4 full-time people. We accumulate 120 years of experience, not one person, but 4. So, but it gives you, it's important for the trust and the legitimacy internally when you discuss with your colleagues, because you know very well the sectors, you know very well the companies, you know very well the thematics, and also with the corporates. Because a lot of time I meet the corporates, I've been in touch with them for the last 20 years. So I can remind you that your management, they said that, and it's very important to progress and not accelerate, but to move, because really we need to move.
Yeah, thank you both. That's really helpful. Anyone else feel free to come in. I might actually sort of cheekily come to you, Andreas, to see, what would you like to see from investors? What would you like to see from the analysts in terms of that kind of closer integration or connectivity or, yeah?
When I just was listening to Jean-Philippe and Richard on this question, replying to this question, I was thinking, financial market analysts, so on conventional financial auto analysts, for example, he needs to, or she needs to publish on a quarterly base, right? So make an opinion about Mercedes-Benz Group on a quarterly base and to publish it to price target. And that's considering long-term social governance topics and also particularly the climate topics. Seems to be quite challenging to integrate, obviously, because it's not necessarily seen in these assessments, except for those parts that are having a short-term impact, like product portfolio, cost position, product mix in the automotive industry. So I don't know if it's also a question of incentivation in some regards, right? With regard to financial markets analysts, not yet investors in general, because investors like you then do the assessment internally. You probably use that research from financial markets analysts, from your own ESG teams, and make up your mind and your decision and do active engagement with companies to clarify points and so on. But on the financial markets analyst side, I think it's still a completely different focus. Because when we made our ESG conference now for the second consecutive year, and where also discussing beforehand, okay, what kind of topics are you interested in, our investors and analysts, ESG as well as mainstream. Actually, from the financial market analysts, there was a feedback. ESG is nice and a trend to have. I mean, it's a trend, and it's definitely not going away and so on, but actually it doesn't play any role for our decision.
On that upbeat note. Yes, a couple of questions here. Lady at the back there, please go ahead.
Thank you very much. I work a lot on democratic governance and inclusion, social economic inclusion in Latin America for decades. We're currently promoting a lot of projects that are smaller, sort of technically, carbon credits, but we're finding that there's sort of a disconnect between what companies say in their ESG and what they actually invest in. Namely that, when you're looking at projects that produce carbon credits, you have sort of, size is king kind of thing. And then, whereas local, when you have it in combination with local human rights and long-term inclusion and development, and all of these things that we talk about, there doesn't seem to be a mechanism to get extra financial credit, which is what they're looking for, right, on their books for these companies. I'm finding that a bit, that's not really a way of thinking yet, despite all the rhetoric. Thank you, and please agree or disagree.
Yeah, anyone want?
Just one comment. We systematically integrate controversies, whatever environmental one or social, and they have more and more impact, materiality speaking. It began with environmental controversies 10, 15 years ago, and now it's also true for social controversies. So I don't say it's perfect, but it's a part of the discussion we have regarding potential greenwashing. Just one comment, because I'm lucky because I started in this industry 25 years ago. There was nothing, no data, no methodology, nothing. And we didn't have in mind greenwashing. We just wanted to progress. And just at the end of the day, we have to believe in people. I mean, NGOs, media, investors, corporates, they can differentiate between solar and coal, between a heat pump and oil sands. So, of course, there is some problems with granularity, but at the end of the day, I think we lose too much time saying greenwashing or social washing or governance washing, because we have so many things to do together that my position is that we have to move. Sorry, I changed my mind in the discussion, but as you open the debate, I can consolidate my position.
Thanks, Jean-Philippe. And the kind of say-do connection and accountability on the corporate side and looking at performance of corporates, that's something that we're kind of really focusing in on at WBCSD, so more to come on that. But if you want to speak to someone about it, say hey to Pepine at the front. Yeah, other questions? Yeah, please go ahead.
Yeah, this is a question for Richard. I was wondering whether you choose to invest more in private equity versus public, because it allows you, if this decision is driven by ESG or not, or if you ever consider this in that decision.
So am I on? Yeah. The fund is relatively unique. So the balance sheet is currently 85% in equities, okay. 15% credit, 20% government securities. So you can work out the leverage. Mm-hmm. And then of the whole fund, it's 55% private, 45% public. So ballpark, the equity split is about 50-50 between public and private. And they're all giving us exposure to equity, but I think it is fair to say that certain sectors are better represented in public versus private markets. Certain things are easier to do in private strategies than they are public strategies. And I'd say one area at the moment where we're seeing some interesting opportunities is actually the ability to do transition financing is actually much easier in private markets than it is public markets. So our ability currently to identify grey assets that have derated because of labeling and commitments from the industry to reduce financed emissions is creating dynamics where we're able to bid in tender processes where there are very little competition in order to buy assets, actively decarbonize them with a view to not only be compensated for the underlying growth in the business, but through the expansion in the multiple, through delivering effectively a credible transition strategy by the time we sell it. So that's one disconnect between the two markets. We have obviously much greater governance rights in private markets than public markets, but we don't have liquidity. And those are two payoffs that are quite cyclical.
Thank you, Richard. Yeah. Or some other hands. There's one, yeah, lady at the back there in the blue. Yeah, please.
So coming back on Richard on CPP, my question was, I think you signed net zero. How do you see the journey on that? And what is the next step on sustainability in your agenda?
Yeah, if you can come a bit closer to the I think it was the journey on net zero for Richard. But if you mind repeating, if that would be... Thank you.
Yes, sorry. So what will be your journey on net zero? How is it advancing? And what is your next step on sustainability? Richard.
To me?
Yeah.
Okay. So we committed to net zero about a year and a half ago. We wanted to be quite transparent about what we controlled and what we didn't control. So we committed that we would deliver carbon neutrality for our own operations by March of this year, and net zero for the portfolio and our own operations by 2050. We wanted to be transparent that we would need some help on changing consumer behavior, advancing technology, the development of market infrastructure, our portfolio companies doing what they say they will, and lastly, regulation. Because we wanted to be clear that what we actually control as a portfolio manager is the portfolio design, the individual securities we acquire, governance rights to hold boards to account, but not to actually set strategy, and then the legal covenants we can negotiate, particularly in credit markets. As a result of our lack of control in the near term over the portfolio emissions, and an appreciation that if we wanted to do transition financing, financed emissions would likely increase in the near term, we didn't set a short-term greenhouse gas reduction target for the portfolio. What we did instead was make a commitment to grow something we can actually control, and that is the share of the portfolio that is what we define as green and transition assets. When we made the commitment, they were 67 billion. We committed to get them to $130 billion by the end of the decade. We ended the last year in March at 79 billion. So progressing a little ahead of trend, keen to assure people that we probably shouldn't be extrapolating the first year's progress. The other things we said we would do, though, would be holding portfolio companies to account. And one of the things we're very focused on at the moment is how we escalate our climate voting process. We're not confident we're seeing the moves we need across the real economy to really align business strategy with the NDCs of companies, of the markets that companies are operating in. Continue to make venture and growth equity investments in new innovation. Scale green technologies when they become economic. And lastly, transition financing. Because it's very clear, you know, just as you say, you can't cut your way to growth, you can't divest your way to net zero. The only way the financial system can support the real economy and decarbonisation is transition financing. And I think it was a great relief for many to see Janet Yellen and Treasury a couple of weeks ago in New York announce their transition financing principles. But that, I think, is the most effective way to leverage finance to support the real economy. Last thing on our own net zero commitment for our operations, we attained carbon neutrality at the end of the year. We now have internal targets for reducing our occupancy and business travel emissions. Those are the two big line items. We did attain neutrality acquiring high-quality offsets. I will say it's not as easy to decarbonize a business as people think. We learned a lot about getting our baseline right. We learned a lot about working with consultants. We learned a lot about the nuance of the carbon market. If anybody wants to share war stories after the panel, happy to share.
Just one. regarding the question of transformation, two other important points. One is ESG objectives in your valuation, I mean, as employee. So that's when we discuss with corporates, do the management, middle management, top management, do they have ESG objectives, and which objectives and the weightings? From our point of view, that's supposed to be 10%. In my firm, for all the people, that's 10%. That's a way to start, because you function with objectives in the private sectors. The second point, which is very important, is training, and training. So we invest a lot of internal and external resources to train. I have that in mind because we signed NetZIM, and we're going to publish our objectives next year, and we develop a lot of tools. I mean, for all people, you manage a fund, a mandate, and look at how you will, it's a game, and you will play to the different metrics, carbon intensity, scope 1 and 2, carbon intensity, scope 1, 2 and 3, temperature, etc., etc. So the best way is also, it's not a nightmare, I mean, sustainability. We like the people enjoy also. And we develop a tool, and this tool is part of the training. That's part of the exercise.
Thanks, Jean-Philippe. Any other questions? And perhaps in particular, if any questions for corporates? I'm conscious the audience here is mainly financial institutions, and this is your moment to politely challenge our friends from the corporates. Yeah, any questions there? If not, wider questions are also fine. Yeah, go ahead.
I just want to ask regarding the United States. I mean, it's actually the biggest market, biggest financial and corporate market in the world. Yet, when it comes to the governance side, they lack any governance codes. And when it comes to let's say the social or the human capital, they are quite extreme when it comes to the human capital. Either it's like really well or it's quite challenging. What's your view in terms of your assets and your investments in in the U.S. Equity markets?
Take governance first. I mean, the US innovates, Europe regulates, I think is what's one thing I heard. One of the reasons the US capital markets in a situation where their governance is maybe less documented in other markets is they have so many founder-led companies that have been very successful as private companies, where a precondition for the founder contemplating listing was preserving asymmetric governance rights. And look, we see that manifest itself in some sectors of dual-class shares. We see it in classified boards. We see it in supermajority voting provisions. I think a few things have changed. The equity capital markets have not been as easy in the last couple of years as they were for the preceding 2 decades. We have seen real change in the proxy research recommendations for new IPO company governance. That is seeing newly IPO'd companies held to a little bit more account. But I think there is a tension that if there's a really, really great company that will not be accessible by public market investors if it remains private, but a precondition for the founder being willing to list is what I'll call off-market governance. I think the real opportunity there for investors, institutions like ourselves, is how we engage in the IPO process in saying, look, some of this we understand and might be open to entertaining in the seasoning period as the company is transitioning from private to public. But the notion that these precedents be left around in perpetuity is more challenging. And we have seen a lot of progress in the last couple of years that the marketplace, both the advisors, the banks themselves saying, hey, we need to make progress on here, this is not going to be as well received by the market, is starting to change behavior. But I think we've also seen a lot more proactive engagement during the IPO process and subsequent proxy voting that has seen a lot of companies that IPO'd with less conventional governance practices move within 2 years of IPO to seek to sunset them within the decade. So that one is, I think, being addressed. On the social side, look, ESG is an amorphous concept. It has become a political football in the United States. I think because it is so amorphous and it lends itself to normative arguments for integration rather than the conversation we've had today. Like nobody today on this panel, I don't think anybody in the room would have said, you must do this because it's the right thing to do. We're talking about we should do this because it's going to reduce risk, it's going to create value, it's going to create systemic change that enhances the value of these companies too. And I think if ESG had been called the management of 21st century business risks and opportunities, I don't think there'd be a debate. Who in their right mind is going to wander around saying, it's against your fiduciary duty to manage 21st century business risks and opportunities? It'd be laughed at. So I do think part of the challenge we're having in the US is that this has been made a normative argument for integration. I think if we can get it back to a fundamental argument for value creation, we'll get to a better place. The other dynamic on specific social elements is litigation risk. And that is certainly an area where we do see systematically lower levels of reporting on certain social metrics in the US. And I suspect there is some legitimacy to the concern that if it's disclosed, it could elicit legal action.
Brilliant. I think I'm going to come back down the front here because there's a last question for corporate. Is there a question for corporates? It is a question. Okay, we'll come here then. We can't let Leila and Andreas off the hook, and then Fiona will do a quick wrap-up, conscious we're at time, but please go ahead.
Okay, so one question for the corporates. What do you think is the most undervalued metrics or factor that affects your ESG performance and results that you wish were taken into account by the analysts, but is currently not?
Great question.
Yeah. Thank you. Would be great to know this KPI actually, because then we could address it and improve it. Unfortunately, it's not as easy as we would like to have it, probably. In this regard, I found it encouraging to hear from Jean-Philippe that they are building up capacities to understand the portfolio companies they are engaging with and so on. And that's not necessarily for all investors the case. I mean, we experience discussions about how the transition in the automotive industry looks like. I mean, simply saying that if you have a current factory, assembly factory out there, if this factory, do you have to write it off completely because you cannot build any battery electric car in this factory, which was producing combustion engines before, which is definitely not the case because you can produce and assemble cars on one and the same line, in the same factory building, and potentially it's even written off anyway. And you have regular cycles where you anyway retool the factories and so on. So there's some education from corporates necessary also to get a better understanding on the investor side. That's something where we try to progress also with investor coalitions. And then hopefully that is providing a better understanding of the transition in the respective sectors, and by that also translating then into the right metrics and the interpretation. As Jean-Philippe mentioned, it's important to know, and if you have that long-term engagement with your portfolio companies, then you have a deep understanding how the business model is working and what is the transition affecting in terms of the business model. And that makes discussions better and more in-depth discussions, and probably helping them better to understand the right metrics.
And of course, it goes without saying, Mercedes' sustainable luxury mobility is undervalued generally, of course. So, Leila, go on, please.
No, it's actually a very difficult question because we, as I mentioned, we do engage with our investors and we will try to address the three pillars. I mean, the E, the S, and the G. On our side, maybe what is the most difficult part is it's really related to our scope 1 because this is where we have the most important carbon footprint. Our scope 1 represents 60% of our overall emissions, and also when you look at the different levers we have today, we are, in a way, a bit limited. We can work a bit on the formulation of cement, but you can't do it because there are norms behind. You can't change, how you manufacture your cement. But you can work on few levers, like, decreasing a bit the clinker content of your cement because this is where, your CO2, your main CO2 emissions are coming from. You can work on alternative fuels, so replacing fossil fuels with biomass, for example, and this helps also to reduce your CO2 emissions. and using construction demolition waste also, but that's not enough, you know, and you will still be left with almost 50% of CO2 emissions, you know, when you manufacture cement. And you need innovative technologies. And on our side, we're investing in carbon capture technology, but we don't know that in 20 years what will be, you know, and it's a very expensive also technology. And as I mentioned, we are investing 2 billion, so we committed to put 2 billion in carbon capture by 2030. And on that, also investors need to understand that if we are also in a carbon-intensive industry, they need also to support us, you know. And we are always challenged about what we are doing, and that's good because this is how also you improve. But we also want to see that you know, companies who are also putting sustainability at the heart of their strategy and doing the right investment, they should be also rewarded by investors. So.
Brilliant. So thank you all for your questions, and a big thank you to the panel. And we'll close there, let you go see a break. Yeah, thank you all.